podcast number 14.
14, sir. Yes.
And we're focused today on 6 mistakes investors make when investing in real estate.
This whole episode, these are all actual conversations I had with people this week. I think the biggest mistake, and this doesn't matter if you're the seasoned investor or if you're the brand new investor, is what is your goal? And the goal for someone who's young is going to, of course, be different for the goal who's someone who's 65. What's your criteria? Okay, some people call that a buy box, but like, what are you going to buy and what are the metrics associated with that buy? And do you have an action plan put in place for you to be able to hit that goal by a certain deadline? What happens is people go, I want to be a real estate investor. I want to do this. And yet we don't create how we're going to do it. We don't create what we're going after and when we want it by. And I think people would be a lot more productive if they simply put some criteria to it. So make a plan, work the plan. The next thing that happens, so item 2 on this list, is they don't shift their goals or their model as the market or the economy changes. So 2017, 18, 19, great time to flip. Going in this up market. All of a sudden, the market started really overheating in 19, 20, 21, 22. Ignore the whole COVID thing. Just pretend it didn't happen for a second. I'm talking the hottest parts of the market. The market was so hot, you couldn't acquire a flip cheap enough to make money because everyone was just overpaying. Even though the economy was doing good, the real estate market at that moment had shifted to such a high degree that flipping did not make sense. So you've got to be willing to change your model with the times, change your model with the economy. 3, and this one is a very big mistake. We don't review our income, our expenses, and then let's call it the headache or the pain and suffering quotient. Everyone that I meet, unless they're hardcore, and I'm talking this is 5% of real estate investors, they underestimate their expenses. They don't go through and they line item everything and then go through and create it as a percentage. You need to be running the property for less than 25% of the total income. So most net operating income should be about 75% of total revenue. If your expenses are above that, you need to ask why. You also need to look at how consistently is the revenue coming in. Doesn't matter if it's a single family, an office building. Do I get my rent on time, paid regularly? And then last, and we've just kind of developed a 1 through 10 system, with 10 being this property is a freaking pain in the ass, and 1 being this thing is awesome. I never have to deal with it. If a property is making me really good money, but it's a 10, it's a massive pain, and it's maybe not in the best neighborhood, I may need to think about selling that and moving that asset into an asset that's just less headache. See, when you own 1 real estate investment, it's fine. When you own 5, it's starting to be okay. As you start to turn this into an actual business and one of them is dragging you down, you need to reduce friction as fast as possible. Otherwise, your portfolio stops growing and your overall return. So you have to reduce friction. You have to reduce headaches. What happens as investors, and I'm guilty of this, is we get emotionally attached. And we're like, oh, but I love that property so much on Casino Road there in Everett. The reality is it's in the ghetto. Okay? And it may make a good ROI, but you may not feel safe going there. And it gets crappy tenants all the time, so just get rid of it. Next on the list is we don't review our loan terms. A lot of these mistakes I'm also guilty of. So you learn as you become this real estate investor is that all of a sudden your 5 years is up and the note was due in 5 years. Your 7 years is up. All of a sudden it's reset to interest only. All of a sudden its interest rate has increased. So what we've learned to do is we keep a spreadsheet of basically the original purchase price, the rent, how much we've raised the rent over the last year, what the deposit is, what the interest rate is, when the note is due, so that we can look at all of our properties together and look at it on a monthly basis. Because what will happen is you will literally miss these things. And all of a sudden you'll look at your spreadsheet just randomly and you're like, oh my goodness, in 6 months, this note is due. Like, I've got to do something now. I've literally had it happen where it was in 60 days. It's like, holy cow, we got to start the refinance today. Number 4, we get comfortable. Comfort is the enemy in just life. Comfort's the enemy in real estate investing. And so what happens is we get comfortable because we went and bought our 4 duplexes and now they make cash flow and they're not being a big hassle. So we get lazy. We get lazy in multiple ways. We let the equity build up and we're not constantly pushing it so our return goes down. Depending on your goals, like we had talked about earlier, there has to become a point where you review the property and you say, this now has enough equity for me to sell this duplex and exchange it into a 4-plex for me to get a higher return. Your property will not have a consistent return over its life cycle. Generally speaking, it will go up to a certain point and it will peak, and then it will just start to decay after that. That could be based on maintenance, that could be based on interest rates, that could be based on rent growth, based on the neighborhood, whatever it may be. Also, when you get a few of them, you get some cash flow. You're feeling comfortable. I have some basic living expenses taken care of. So you take your foot off the gas. The thing to understand, though, in real estate investing is if you're not growing, you are dying. Especially now in this high inflation environment. So inflation, even though the government said inflation, it only hit like 9%. Inflation for us real people was like 15%, 20%, just astoundingly high. Well, that means if my real estate was not performing at a high level, I was losing money in that moment. And now with inflation being 5%, if my asset's not performing at 6%, 7%, 8%, it's not performing high enough relative to inflation. So we kind of have to naturally check ourselves, but we also have to think about our goals. So if you're in the latter part of your real estate investing career, part of it will be to de-risk, pay down debt. You won't be accumulating as much. That's okay. But at our age, it should still be gas on, it's game on like Donkey Kong, let's rock and roll, just keep buying. These last two, unfortunately, I think are the most important, and these are the biggest problems. Analysis paralysis. In real estate, I've met many investors. They're getting ready to get ready to get ready. And they've got a spreadsheet, and it's not quite perfect, so they just don't pull the trigger. By simply taking action, you will get further ahead than the person who doesn't take the action. Don't be stupid. Make a conservative judgment. Have cash reserves, protect yourself, but don't get stuck in analysis paralysis to the point where you make no investments and you do nothing. Okay, last but not least, number 6, investors think they have to have money to buy real estate. OPM, other people's money. If you have a deal, someone else has money. Your job is to find a phenomenal deal. And if you don't have the capital, find a partner. So also don't be greedy. Let the partner win with you. Give them a phenomenal deal. Go do a second deal with them. Go do a third deal with them. And then over time, maybe their returns slim out a little bit. Or over time, you make so much money off that partnership that you no longer need them. But allow them to win too so that they want to do a deal again with you. The most important thing is finding the deal, not having the money. Those are the 6.
Yeah, it's great stuff. And I just have a few questions for you. Like number 1, you say that people don't have a goal, right? So they just want to make money. That's too generic because everybody wants to make money. You could make money in the stock market, right?
I could hand you $1.
Yeah.
You've just made money.
There you go, right? What are your thoughts on the importance of having a goal so that you don't get derailed from somebody else's win or loss?
Oh, yes. Yeah. The FOMO, the Joneses, and we have it actually really hardcore. I think it's worse in real estate investing than in real life because what happens is your competitive nature kicks in and you go, oh my goodness, Benji's beating me. He's got hundreds and hundreds of units. I got to go catch him right now. So slow down. You're playing your own game. Relax. You'll get there when you're supposed to get there. But get specific. So the first thing I think people should be thinking about is, what is my freedom number? So if your expenses are $10,000 a month, you need $10,000 a month in cash flow, and you've just created a freedom number. So if you don't have a goal, just make your first goal your freedom number. How do I get enough cash flow coming in order to cover my base living expenses. That's probably the most important. Other than that, pick any goal. Oh, I want to leave money for my kids, or I want to pay for their college, or I want to leave a legacy behind, or I want to start a foundation that owns, 400 acres out here in Granite Falls where kids could come and, ride motorbikes and climb trees. Whatever your goals are, just try and get specific about it. Because if I've got a true north and we're like marching towards that, that'll keep me going when I have setbacks, because setbacks are going to happen.
Totally. And in addition to the goal, I think even more practical is the plan, sticking to your own plan, because one of the reasons it's worse in real estate, in my opinion, because it just takes a lot longer, right? So, as the market is changing, of course, we might need to make adjustments, but sometimes we don't. We just have to ride it out, right? Yep. And just life has gotten easier. Unless there's like a nuclear war, we're going to all be fine. And guess what? Your investment too, as long as you did all the numbers. Another thing you mentioned in number 3, don't regularly review their income, expenses, and headaches. I think one thing for sure within that is they're not constantly looking at market stats.
Yes.
Right? So of course, once you do have an investment, it's not about making adjustments based off of that, but it can help you maybe like when it comes to refinancing a loan. But probably most important, when you're looking to make a decision on an investment, just looking at the stats, right? Yes. Understanding the stats. If you don't know it yourself, you should talk to someone like Anton, right? That does know how to decipher the things. Yeah. I think it's one of the most, it's kind of like stretching with working out. You have to stretch if you want to avoid getting injured. Well, you got to look at the numbers if you want to avoid making a bad investment decision. Any thoughts around that?
I think just like stretching or working out, because that's a phenomenal example, you should put in your calendar that the second Tuesday of every month from 1 to 3 p.m., you review your real estate. And then right before you do that, at noon, you review the market. So maybe you take 20 minutes, you look at the market, you look what's happening. If you're not an avid investor, maybe you schedule a phone call with your favorite real estate broker or your mentor, whoever's going to get you the data, and you have that. Then you weigh that data against how your asset is performing. Here's the market. How is my asset performing? What's my next step? If my next step is just continue holding, great. But see, at least then we're making an informed decision, which is active versus just passively letting life happen to us.
Totally. And really, there's only 2 things I want to add here when it comes to analysis paralysis, right? People don't know when to pull the trigger. And really, the strategy, I think it goes back to what you just talked about. If you're looking at the numbers, you're going to be able to recognize when there's a good opportunity. And that's, I think, a common way that I am able to make a decision is when I'm comfortable understanding the market. Any other strategies to knowing when to pull the trigger when it comes to analysis paralysis?
I think if you clearly define your criteria is what I call it, some investors call it buy box. If you know that you want to do a flip, and on the flip, you want to make 15% on your money. If you find the deal that allows you to make the 15% in the timeline that you want without additional risk or hassle, that's a buy signal, buy it. And so it's getting strict, disciplined, and having a framework by which you can make a decision and then sticking to it. And if you don't have one, you need to go develop that criteria and then work it against the market. Work it against the assets you have. So we have a performance criteria for our existing properties. And if they stop performing below that or the headache gets too great, bye-bye. Bye-bye, Felicia, you gotta go. And we just go replace it. And that way we're not making emotional decisions because we all fall in love with real estate.
That was the bonus mistake to avoid. Investors making emotional decisions and reacting in irrational ways.
Yes.
A lot of this stuff is going to help you avoid it. But it's funny, even if you do avoid these 6 mistakes, we all get emotional. And what I found in all my years, because I made this mistake very early on, I remember that my first flip, right? It was in Renton, Washington, and I had bought it at auction, and it was a fixer-upper, and I wasn't getting a lot of offers because the market back then was really slow. And so somebody found the problem in the foundation when they put in an offer and everything. And so the way the agent talked to me, it built a lot of fear into me because that agent could do laps around me, and I made an emotional decision. Probably took way less than I should have. Now the market back then, like, we just need to get rid of the property as well. But the point is, I remember I wasn't making a rational decision. I was making an emotional decision out of fear, and that is probably something you definitely want to avoid. And you almost have to kind of be a robot.
Yep.
And I think the other thing you did, we didn't bring this up, a way to avoid emotional reactions is dollar cost average into real estate.
Yep.
Because that's part of a plan, right? Like a long-term plan. But what are your experiences, or what are your observations of, especially beginner investors making emotional reactions, and how that can really ruin everything?
How do you create a decision framework, a model that has criteria with numbers attached to it, so that every time you go to make a decision, it's just that? And you work down a checklist. I'm not an organized person by nature. That's not me. And I do this. Why do I do it? So I can cut the emotion out of it. Because whether we like it or not, we all need to admit this to ourselves. We all have some type of an emotional attachment to money based on our upbringing, our childhood, whatever it may be. So you're just going to have it. Let's admit it. Okay, we've admitted we're going to have an emotional thing. Well, cool. How do I limit my emotional response? I create a system and a process or a decision framework with numbers and criteria attached to it, and I simply work through it. I'm probably going to get an offer on a piece of land that we own, and they kind of told me what the offer was, and I mentioned to Jennifer, we'll just counter back. She goes, that's a great offer. You should just accept it. And I said, well, emotionally, the buyer won't feel as tied. And she goes, what are you talking about? It's a good deal. Take the offer. I said, yeah, but you got to be the pretty girl. I got to fight with them a little bit. I got to run away. They got to chase me. They got to track me down. Then we'll sign the offer, and then we'll all feel good about it. She goes, you're crazy, and walks out of my office. The reality is, it's going to be a great offer, and I'm still going to counter back, because what that does is that creates that emotional attachment. If you just accept right out the gate, then there's not the emotional attachment. They didn't chase you enough. We just went through the mistakes that people make. And so let's dig into one specific spot here, because see, there's all these excuses that landlords make about not raising their rents. And I want to start with a basic premise here. Real estate investing is a business, and we need to treat it like a business. So before we talked about non-emotional attachment, right? But also run your real estate investments just like they're a business. If you're not running it like a business, you actually have a hobby, and you're creating risk for your family, and you're not going to create the legacy that you want. Here's the most simple things, and everyone's going to laugh, and so I get it, but this is what we hear from everyone. Well, my tenants are really nice, so I don't want to raise the rent. I feel really bad raising the rent. They can barely afford it right now. If I raise the rent, they'll leave. There are different quality of tenants. And I've got good ones right now. And if they leave, I may get a bad tenant. This is how I avoid turnover, Anton. I just don't raise the rent. Well, then if they move out, I'd have to do some repairs. Well, I don't think you're thinking about this. Time is money. What do all of these excuses have in common? What are you thinking?
You're just scared. You're scared to be mean, even though it's just business. It's just part of the investment, of running. It's just like running a business, and it's unemotional.
It's just fear.
Because if you don't do it, someone else is.
It's fear, but what's happening is your fear of loss is preventing the maximum return for you, your family, your heirs, whatever it may be. And so the thing that people also don't take into consideration when they don't raise the rent is are their taxes going up? Is their insurance going up? Is the cost of maintenance going up? And so that's always happening. Now, I'm not saying you have to be the vulture landlord, the guy who always raises the rent, who is the max rent in the area. That's not what I'm saying. But you need to keep up with market values so that the tenant respects the property. And one thing I will vehemently disagree with, you actually do need turnover, because there's a real really big difference in maintenance when I'm fixing a property after 1 year, 2 years, 3 years, 5 versus a tenant that's been there for 7, 10, 15. I will tell you the long-term tenant has always caused more damage than the short-term one. And the reason for it is you didn't go in and make a bunch of the general maintenance you would have normally made. And so what happens is that you get hit with this massive bill all at once, and it literally hurts my heart. The kid from Arlington goes, oh my goodness, this is so much money. Why did we do this? How do we make this mistake again? So by simply raising the rent, you get that natural turnover rate, which means you naturally put the money and the maintenance into the property, which helps prevent having these big bills just show up all at once.
I have one question.
Yeah.
Is it good or is it a common practice to be upfront about future changes? So whether it's in the contract or your property manager, literally relaying to the new tenants, hey, commonly we raise the rents once a year. We assess if we need to raise rents based off of market conditions or stats, because that also kind of takes away that like fear because you've already given them a heads up and they expect it. Also, on that note, a lot of tenants know rents get raised too, right?
Yeah.
You know, it's like you're not the only person doing it.
No, I mean, number one, it's extremely common. Number two, rent growth, unfortunately. So this is a whole affordable housing issue. We've gone into this in some of the other podcasts, but we have a supply issue across the United States that's causing massive rent pressures. That's a government issue, a land development issue, an entitlement issue that has to be solved. So I actually feel for the tenant in this situation because the government is punishing the tenants by not allowing enough supply. Okay, now that we've said the rant, I think that up front you could say, generally speaking, we raise our rent 3% every year, or we raise the rent $100, or we raise it $5. Now, very rarely are you going to have a market condition that's going to cause a massive jump, except for the last 2 years. So if we look out over a longer period of history, rent is just slow, consistent growth over time. And in some areas, flat. But here in the Seattle Metro, very consistent rent growth over time. So absolutely. I think the more upfront you can be with the tenant, the more real, the more human, that's awesome. That's just... It's being a good human, number one, and being a good landlord, number two. So another, just story that came up this week was, hey, if I wanted to learn the real estate market really quick, what could I do? How would I learn the real estate market in the next 30 days? It's actually easier than people think. What they don't do is they don't set aside the time. So one, time block in your calendar, 20 to 30 minutes a day to sit down at the MLS. If you don't have the MLS, I get it. We're not all licensed real estate brokers. Go to realtor.com, go to Zillow, go to Redfin, go to blah, blah, blah's website. Open it up in your area. Look at the active homes, look at the homes that went pending or under contract, and look at the ones that sold. Start trying to track how many actives come on. What's the average days on market? What's the price per square foot? What percent are they selling for of the list price? What's my supply? Buyer's market, seller's market. Then I think people should go to open houses. Go out, physically look at the inventory, touch it, look at it. See, everyone listening to this has a hobby or something they love, and they look at it a little bit relentlessly. What's something you look at on your phone?
Oh, right now, dirt bikes.
Dirt bikes, perfect. So you're going to go on Craigslist, you're going to go Facebook Marketplace, you're going to look at KTMs, you're going to look at Hondas. Whether you're Team Red or Team Orange.
Red, of course, all the way.
Red, okay, Team Honda. So after 2-3 weeks, you know where all the CR250s are. You know where the 4-strokes are at. You know, hey, there's better deals in the Enumclaw than there is in Bellevue. There's, there's 2 good deals right now up in Mount Vernon. You just start to get a general idea. And that's what I want people to do. You're already doing this. I just want you to set a little time aside for real estate. The next thing you need to do is you need to drive around. Like I'm talking street by street, like grid it out. So if you live in Seattle, Washington, and you live in Ballard, and you wanted to learn the Ballard market, I want you to drive down every street in Ballard. And then I want you to get out of your car and I want you to walk around during the day and pull your phone out and shoot some pictures of things to remind yourself and take some notes. That's how we learn the market. We learn it by physically touching it. Then let's go join some real estate groups, both in person and online, Facebook groups, meetups, things like that. Create a simple spreadsheet. So earlier in this thing, we talked about having that criteria, right? Having that buy box set up. Start paper trading your real estate, just like you would a stock. 123 Main Street, bed, bath, square footage, condition, price, offer amount you would offer, what the return would be. Watch what happens in the MLS. Follow up with it 30, 60, 90 days later. What did it sell for? By simply tracking a few properties, you'll start to learn this. We have, I think it's 398 potential flips still in this spreadsheet. And we just keep adding to it. It's every flip we've ever looked at over the last few years and everyone we've made an offer on. So we can go back and we can see based on what we thought the repairs were, what people got. We talked about learning the statistics for the market. And then I think you should make some offers. Tell me you don't have the money. Just say, I don't have the money.
I don't have the money.
Go make a stupid lowball offer and see what they counter back at. Because what you're trying to do is you're trying to test your hypothesis just to see what happens. Now I understand the market. I understand what these numbers look like and where we are at. If we don't take the time to learn the market, then we don't know what we're buying. And that's really it. I mean, plain and simple. Any thoughts, questions?
I have a story about a dirt bike that applies to...
Let's go for the dirt bike.
Okay, so the last dirt bike I bought, right? I did exactly what you're talking about. I looked on OfferUp, Facebook Marketplace, Craigslist. We're talking for 2 or 3 months. I had a friend who's into those, send me listings. And one of the things that you do when you look at so many people trying to sell and even calling them up, right? Just fill it out, is you'll get a number or a range, right? A low and a high.
Yeah.
Of course, there's different years. There's different types of Hondas out there. I don't even look at KTMs. And literally, you just are going to have an idea of like what the going rate is.
Yes.
So that when you do spot a deal, you know.
Bingo.
And you go to it, right?
Yes.
And so there was a deal in Eastern Washington. So I had to drive all the way across the state. It was totally worth it, though, because we're talking, it was like easily $1,500, maybe $2,000 discount.
Wow.
And then always the question is, well, what's wrong with it, right?
Yeah.
And so you talk to this person, and long story short, this person that was selling this bike wasn't even the person that owned it. He was selling it for somebody else, somebody that didn't know how to put it up onto the website, and somebody that didn't use the internet or whatever. So I was like, okay, cool. Well, I didn't even question it. I didn't say, hey, what's wrong with bike? I was like, I will go there at the chance to save potentially $2,000. When I showed up to this guy's house, the dirt bike looked perfect, right? But he had no phone, no computer, no internet, okay? So he just doesn't have an awareness of the market. Also, he wanted to sell his dirt bike so he could go snowmobiling in the winter, which, by the way, my friend who buys and sells dirt bikes all the time, he told me that exact thing. He's like, this guy's just trying to sell his dirt bike so he can go joyride in the mountains during the wintertime, right? And he was exactly right. The point I'm trying to make is there's a couple things. Number one, I understood the market because I was always looking at the numbers, right? So that I knew to go right to it. Secondly, I understood because I met him some of the reasons why maybe he doesn't know what the going rate is. Now, I'm not into, trying to take advantage of people, but in this case, like this guy just didn't know what he was selling, right? But third, this is the most important, the motivation.
Yes.
This is why it's important to pick up that phone. When I was an agent, that was the most powerful thing I did because I go, well, why are you selling? Hey, I'll give you one little a one-liner I use to this day in my business and in real estate. I literally always end the conversation with, oh, this is a nice house or this is a nice property. Seems like weird that you would sell it. What's wrong with the neighborhood? Is there like something like down the street that you're avoiding or whatever? And they, oh, no, that's not it. No. Actually, the reason I'm selling this is whatever they say is what you need to remember.
Yeah, 100%.
And you can literally do this with real estate. But the difference is you might not be selling being $2,000. You might save $20,000 or $100,000.
Exactly.
And I know you've made way better savings in the future. Everybody can relate to looking at deals on Craigslist or whatever, looking for that dirt bike, looking for whatever it is, exercise equipment. The same principles apply to houses. And weirdly, it's actually easier because less people are doing it. Less people take the time to look at properties and do the spreadsheets, right?
Yep.
Less people are willing to just drive and talk to people because they have this assumption like, oh, you have to be an agent. Oh, like I'm not experienced or whatever. In fact, the people that have the least amount of fear, that don't care, that actually do talk to people, oftentimes find the deals, off-market deals, and usually become the most successful investors because they're not going through the regular route of, hey, by the way, I'm not trying to take business away from you, Anton, but the reality is like, hey, agent, can you tell me this and that, whatever, and then just wait on them. No, even as a client of an agent, you should still be doing your own homework
100%.
so you know that they're doing a good job. Now, if you work with someone like Anton, this is his bread and butter. This is what I would argue makes you different than other agents because you obsess about numbers. Like literally, you'll price homes just for fun, just for shits and giggles, and that's what. And that's making the blade sharper. So
100%.
So yeah, everything, that whole story was just to tell you. I did get that dirt bike, by the way, for basically $2,000 less than what it's really worth, right? But it's also because he was motivated, so he didn't even question it, and I rode it home. So
and you did the due diligence, you learned the market, and you asked amazing questions. Like that caps up this whole episode. What am I doing? Why am I doing it? What's my goal? How do I ask amazing questions, learn the market, find the motivated, do the deal? Subscribe, hang out with us, do whatever you want, make some comments. Love you guys. Bye.